Welcome back to the Investor Summit on the Singapore FinTech Festival. Let's go now to the panel with Steve McLaughlin, the the founder, the FT Partners, founder, Chief Executive Officer, and Managing Partner. This is a panel that's going to look at investors' priority for the coming year. Let's go now to Steve and his panel.
All right. Well, thank you very much. Appreciate the Singapore FinTech Festival having us all on. This is Steve McLaughlin, founder of FT Partners. We're an investment bank focused exclusively on the global FinTech space. And I'm excited here to have a star-studded panel. We've got, in no particular order, Sheel Mohnot from Better Tomorrow Ventures, his new fund that's rocking it these days. Michael Gilroy from Coatue. We've got Andy Young from Permira. Amy Nauiokas, I got that right, from Anthemis, and last but never least, Dan Rosen from Commerce Ventures. I'm going to go around, and not the order I even told you guys, but Sheel, since you're right there, we will get to your dating life. And by the way, I told Sheel, if there's anybody on the phone that would date this guy, he's been doing a lot of online dating during COVID. He's a better dater than anything I've heard. But anyway, Sheel, talk to us about, you can talk about your online dating if you want, but in all sincerity, you just started a new fund. You've been investing before with 500 startups. You were looking at hundreds of fintech companies. What are you guys looking for in the market right now, and a little bit of what's going on in the market? Because seed and Series A market is wild right now for the better company.
Seed and Series A is crazy, but like down the line, everything's crazy, right? Like
everything's crazy.
We thought with COVID, February, March, I was looking for deals. I was thinking, oh yeah, it's gonna be great. Valuations are gonna get reset. We'll be paying, $5 million for seed rounds. Unfortunately, that's not what happened. And I'd say valuations are higher than they've ever been. Probably, I would say 25-30% higher than they were at the beginning of this year.
But sure, why is that? I mean, we're all seeing that, right? But like, what changed? And you think in a bad market like
look at the public market comps, and if you look at those, then everything should be worth more than it is today. And maybe people are saying, hey, like everything that we'd anchor to is no longer accurate because look at these public comps, look at Credit Karma, Plaid, et cetera. And everybody's looking for fintech. It's amazing how many people, if you look at their Twitter bios, how many people changed their bio to fintech investor. If you look at their portfolio, they haven't done a damn thing in fintech, but now they're a fintech investor. So everybody's following us. Like all of us on this screen have been doing this for years, but now it feels like with these exits, everybody else wants in.
Yeah, it's true. Michael, what about you? What are you seeing? You guys are in the thick of things. You guys just started a new fintech fund. I've been doing some stuff behind the scenes. You guys are pretty active. What are you seeing? Why are you guys so excited about the space?
Classic, the theme of 2020. I can't disagree with anything Sheel said there, and I think it's true really across stages. What I will say in fintech, we've kind of been looking for this one-time catalyst to really pull forward many of the themes we've all been excited about for a long time, and the P&Ls and just growth of some of these businesses is truly extraordinary.
Yeah, absolutely. And I guess you guys are both kind of investing out of the U.S. And Michael, I know you look all around the world, but Amy, you're doing more out of the footprint of Europe. Talk to us about what you're seeing there. And look, we got a worldwide audience here, so give us maybe a worldwide perspective.
I would agree with the guys for sure. I mean, I think that in part it's this sort of wonderful moment where we've all been sort of forced to look at what happens when you don't have a ton of resiliency in your financial system, and all of us are investing in companies that are meant to actually create more transparency and resiliency. And so in that sense, I think that the sector has finally found its moment, and it has sort of a bit of momentum around it. I think the other thing that certainly we've seen, and we've been investing both in Europe and the US for some time now, is that the kind of borders are off now. And I think that at the moment that the Valley might have been the place where all deals begin and end, that was never really the case for fintech. And I think in this new world order where people aren't stuck, to being regional because nobody can meet with anybody. You're seeing a ton of volume of transactions and opportunities to meet people that borders kind of don't matter anymore, right? And you can have as long as you're willing to kind of stay up 24/7, you can have conversations and virtual meets and coffees with entrepreneurs anywhere. Europe is extremely hot right now for us. I think valuations, we used to have a theory that if you started a company in Scandinavia and just moved it west every quarter, it would get bigger and more bloated by the time it got to the valley. But valuations generally, while they are extremely robust, they feel like they're evening out globally, which I think is a good sign. I think another signal that we all are paying attention to is that 2020 vintage funds are going to be they're gonna blow it out of the water, right? And that has a lot to do with the fact that anytime a vintage kind of emerges out of the wreckage of a major correction in the economy, you see huge amounts of success. And so I think folks that have the capacity to allocate and focus on this as venture as a sector are looking at this particular moment and recognizing that this is going to be the 2020 is going to be the year to get into funds.
Dan Rosen, you guys are in Bill.com. The thing's on fire. It's off the charts. We got in really early. Marqeta, you were in before anyone ever heard of Marqeta. You helped me get into Marqeta, so I owe you for that one. But at the end of the day, what's driving some of the big multiples here that you guys are seeing out in the marketplace? And you're seeing it because you're owning some of these companies that are either IPO and they boomed or they're on the brink of it, and you're investing in the early stage. I mean, how are the valuations going up so quickly in some of these? I mean, Bill.com pre-IPO round was $1 billion. Now it's trading, what, $10 billion or something? Like, why was it so cheap pre-IPO and so robust post-IPO? It has not been that long. That valuation has gone up 10x in a year and a half.
Well, I can't tell you how the public markets think about things, but what it seems to me is that there is a shortage of growth that you can invest in anywhere in the world right now. So all of the world's money is trying to chase growth, which is singularly focused on tech. And I think, we as a firm do relatively early stage investments in the retail and financial services ecosystems. We call it the commerce continuum. And if I think about two areas that are changing dramatically, and thus there's a lot of growth in the digitization of those industries, I think, kind of commerce and financial services are two of them. I mean, just look what's happened with Airbnb, look what happened with DoorDash. But certainly players like Marqeta, who are powering DoorDash, powering Instacart, powering Affirm, are benefiting from this enormous growth in these digital players who are effectively changing the way that we all spend money, save money, shop, so all of those changes in consumer behavior require enablement. They require infrastructure. Those are the types of things we're excited about.
Yeah. And last but not least, Andy, just coming back to you here. I mean, you guys are much later stage than the other folks on the phone. You've made some incredible bets. The one I'm thinking about off the top of my head is Klarna. If you could maybe throw in, I got a tricky question here. I mean, it feels like this is a conversation that was had maybe, you could have had like right around the time of the Lending Club IPO, and On Deck was spiking up and Lending Club went up to 10 billion, and there was like a lot of hoopla, and then every other alternative lending company raised money. And obviously Klarna is a very, very special company, but putting that aside, why did things sort of blow up then? A lot of those alternative lenders didn't really make it. But is everything more real now than then?
Yeah, I mean, like if you talk about buy now, pay later, we're not looking into the traditional sort of marketplaces of alternative lenders as much. And you've seen some, and Steve, I think you know that well, Green Sky and others have had a slightly harder time. But the beauty of the buy now, pay later business model really is it's driving additional customers to merchants, and it's. Hey, I'm sorry. Hey. Just had a 5-year-old intruder. I'm sorry.
Come on, get him on the screen. Get him on the screen.
What we're really backing there is a couple of big themes in terms of buy now, pay later, which is the rise of e-commerce and rise of alternative payment methods, and consumers want choice. Millennials, I think we've all heard that millennials don't trust themselves with credit cards. They don't trust banks. In that case, Klarna is really unbundling each transaction, a credit card, every transaction by transaction. So I think that's slightly different. There's much smaller AOVs. We're not trying to, the business is not trying to fundamentally disintermediate bigger purchases. The average AOV is around 90 euros. And it's a mentality change on this younger generation who are who are really, who don't want to be stung by fees forever, and they're happy to know that they can pay over the next 6 weeks. They can pay off their pair of Acne jeans for $200, and they can do that. So really a couple of themes, and they've been around some time. In terms of valuations, though, Steve, I mean, we were joking about it. It used to be sort of 15 times EBITDA in sort of later stage world, and we do growth as well, but 15 times EBITDA, then it was 10 times revenue. Now it's pretty easily 15 times revenue. And I don't know where that stops, but what we're spending our time on is fundamentally focusing on business quality. And that's, sometimes you have to pay 15 times revenue for fantastic quality with strategic value. That's the lens that we take every which way when we're looking at the moment.
Yeah. Michael, you look at a lot of deals and you don't do a lot of deals. So what is the difference maker for you? I mean, you do a lot, but compared to the number you look at, what's the difference maker for you? Like, what are the 5 things that you need to see lining up on the slot machine before you say go? You see a lot of things.
The first thing, and it's basically cliche at this point, but whether it's a C-stage company or a public company, we talk about the team first. And it continues to be the North Star, really, regardless of stage. So that's number 1. Number 2, we're very, very thematic and focused on very large markets, right? We feel like, we're talking about B2B payments here. It's one of the biggest markets on the planet. And so when you can assume, single digit bit penetration and a multi-billion-dollar outcome, that's just a pretty good setup. So these are the types of things that, we tend to be really excited about, beyond the basic inflection points and these types of things that every investor will tell you.
Talk to us about the digital banking space a little bit, Dan. There's probably 20 years of my life, there's been nothing going on there at all. And then 3 or 4 years ago, some of these companies really started taking off. In the last maybe 12 months, the valuations have gone through the roof, and you're starting to see these things become more of a super app. So, is it going to be the case that, the Chime and the Revoluts and Number 26 and Varo and all these guys just essentially paste together, every single functionality a consumer could use, and with all the data, the information, the connectivity in one app, is that really happening in a way that's credible? And obviously with Chime being as successful as it is, but how are you seeing that space play out?
Yeah, I mean, and this, I've been investing in that space for longer than I care to admit. I think it feels clear to me that there's going to be a number of winners in that space that will eventually cross-sell credit into a DDA customer base, into a deposit account customer base. Being a kind of a neobank who just has kind of a checking account, an online checking account, is not enough. There's not enough long-term profitability there unless you become a bank. And it's unclear what happens if you do become a bank and how you're valued. So I think there will be a few at-scale winners. I think there's going to be a lot of players who are subscale who don't survive independently. It doesn't mean they're going to fail. They're going to have to find a new home. And if I was going to drop a grenade in the middle of this room, I'd say, and we're investors in this category too, I think the proliferation of banking as a service platforms is I would dare say overhyped and overinvested. And that is creating a bunch more neobanks, if you will, that are yet to be built or just being built right now. So I'll be curious to see what happens to all those players. But the consumer doesn't need, I don't think, 20 different bank accounts. I think there will be a rationalization.
I heard somebody the other day talking about a debate between whether the digital banking apps ultimately start offering, buy now, pay later, and then there's this sort of the pure play guys. Do you have a point of view on that, Andy?
I think there's definitely. I mean, when you look at businesses like Acorn, Stash, Robinhood, everyone's on a path towards each other in a way, but they all have a different hook. They all have a different hook. I mean, and Chime as well. Chime, you want to get paid a couple of days earlier. Robinhood, you want to punt Tesla stock. There's all different things that you may be looking to do. I think they ultimately get there, but they're different customer base. I think if you look deeply into those. And so I think the question sort of that Dan mentioned around whether these neobanks, you look at Monzo, hasn't had a great run lately, whether those are able to get into lending in a sustainable way. I think in terms of buy now, pay later is probably true, but I think you really need to start in the merchant for buy now, pay later to have real credibility. And you've seen Afterpay, Klarna, and there's a couple of others that have real credibility from their merchant relationships. And if you're not in that Sephora checkout, what's your relevance and your introduction point to the consumer? I'm not sure you have one. So I think it really has to start in that merchant, and spin back to consumer preference thereafter. And that may end up going through an app.
Yeah, Steve, I would actually add to that beyond just the banking, even the personal finance platforms, right? We're really starting to see a trend away from traditional, using your platform as asset and liability management through an array of different products and services, but more about, and this is a big part of our financial wellness view, about helping people achieve their full potential and solving for their core needs, right? So where are you on the life cycle? Are you setting roots and looking for housing? Are you in personal growth mode? Are you educating your children or paying for education, building a life, building a legacy? And there's really been a shift from that product-driven offering to a more needs-driven. And we have so much data about consumers now that we're actually capable of doing that. So I think we're quite excited about a lot of the platforms that they might solve some of the same problems, but they do it with a different approach. And I think Happy Money is a great example of that, right? So in its sort of lifespan, it's already helped 120,000 customers repay about $2 billion in debt. And they've done it through a more ethical and sustainable approach to lending, which is speaking incredibly well to certain demographics, including and not only, but including the millennial population.
Sheel, is it too late to get into the game on digital banking? I mean, is there going to be another Chime started from scratch in the next couple of years, or are people just saying, look, it's game over if you're not Chime or Revolut or, VAR or one of these guys, Step, which is, is doing great. What can you start from scratch at this point?
I actually think you can. And I think there are a lot of these businesses that are going after this like millennial audience. Chime is a perfect example of it. I think there's another generation that's just now coming alive, which is Gen Z. And I think that none of these products are well built for them. I've become friends with some of these like 18 to 20-year-olds, and like the shit they talk about is crazy. They're like, why can't I buy a candy bar with my Tesla stock? And I don't know if that's the answer. It's not the answer for me. That's for damn sure. But like the way they think about things is so different that there's going to be another business like this that comes up just for them, and it's going to do well.
Dan, what do you think?
Yeah, look, I'm not going to disagree out of hand. I think what I'd say though is I don't think they will look like the digital banks of today. Where I think the piece that we're assuming, which I don't think is fair to assume, is that 5 years from now, 10 years from now, people will visit a destination to bank, like whether that's a digital destination or not. Right, we'll have solutions for our lives. We'll have a whole bunch of infrastructure and utilities. Like banking could be very much utility driven. The way that maybe some of our devices are connected to the cellular networks, but they're not phones. Right. I think that in that world, I think you're right. That there could be a whole different generation of banking that we haven't even conceived of yet. But I'm not sure that there needs to be another respin of interfaces for banks, or that there'll be a whole new set of digital neobanks that come after this one with a similar set of interfaces.
Who wants to take this one? You've got, obviously the Googles of the world, Amazons, Apples. They're barely tipping their toes in fintech and financial services. There's regulatory concerns. There's all sorts of things, and there's been a bunch of failures. I mean, Google's really tried to get into insurance and payments and other things, and it's been tough. Facebook's got Libra, but not much else. So, who wants to take a shot at? When are we going to see the big U.S.-based e-commerce companies do more and more in fintech? And Apple's got Apple Pay and such, but any guesses? Anybody?
Yeah, I think it's starting, but I think it's also about the way we're talking about this narrative, right? So there's a lot of talk in the industry right now about this idea of embedded finance, which we said earlier, right? The concept that the rails of the financial system, how you transact, how you finance and lend, and how you risk manage, really exists through every single industry and every single company that exists in the world. And what we've always, with the big banks and insurance companies, have always said is, okay, we've got, we understand the market and the structure. The only way to do it is through us to those other rails. But the reality is the rails can exist without the infrastructure of the banks. I'm not sure who just said it, But what I think is starting to happen now is this narrative is changing around, we've been saying fintech for a while, but it's like this tech fin model, like turn it on its ear. The big challenge is going to be the regulatory structure. How do these guys, do they build a safeguarded regulatory structure that respects and appreciates the way the markets work and the way the world is working, but at the same time, it doesn't have to be exactly the way the current financial system space is regulated. And so I think part of the problem is that they've gone in thinking we can just go around it completely and building solutions or trying things that we've seen, what happened with the first round of Libra. Like it's not possible to completely disregard the regulatory framework that is the financial services industry. But I think we will absolutely see in the next 5 to 10 years a massive shift towards regulation that is different than what we currently live in, to take advantage of the fact that every single company in the economy will be a fintech company.
From your lips to God's ears, I love it. Anybody else pick up on this one? Toss it out there.
I mean, the one thing I'd say is, look, the Apple credit card was, from everything I understand, the most successful credit card launch of all time. And I think we should all believe that if Amazon ever launches a, kind of mainstream checking account, they will quickly become a top 5 institution in terms of number of accounts. So, my guess is, and then all these players are doing a lot in financial services already. We see it. We see PayPal, Square. Even what Shopify is doing is really interesting. But I would imagine that we will see some of those players go deeper, and I think they're already pretty far in, further in maybe than we're giving them credit for.
I'm surprised that Amazon hasn't done more, to be honest. I mean, maybe healthcare is a bigger opportunity for them, and there's a lot of talk about that, but they haven't done as much as you might think. I think Instagram is probably headed a long way towards becoming a real Shopify competitor. And you think away that, it's kind of a crazy thing, right? You follow things, you want people to actively advertise at you. If you hunt around deep enough, even as of a couple of years ago, if you play around long enough in Instagram, you'll find a setting where you can include a payment, and that's been there for some time. So I think that's one that, is really speaking to that generation who wants to be mobile first and wants to be instant gratification.
And helping that generation, I think that's a perfect example, that trend, that kind of how you find the finance embedded in the media space. We're seeing a lot of companies right now that are looking to monetize the way people purchase things, buy houses, get mortgages off the back of the stuff that they're, not just their likes, but the stuff they're being paid in. It's not easy to monetize, a mortgage if you're getting paid in Louis Vuitton bags. But believe it or not, there are companies out there that are actually looking at finding solutions for those people, and they're properly in thesis.
Yeah, Steve, I think as we look at some of the skilled folks that have distribution, there's really going to be an inverse relationship between current multiple or success of the core business and kind of propensity to launch financial products. You go out and you talk to a lot of these management teams, and they say, look, we're trading at 20, 30, 40 times revs. Why on earth would we ever risk that to launch financial product? Core business is doing great. We can't deal with some AML compliance issue that comes and kind of hurts that. So I think we will see it. I actually kind of take the under on it a little bit, just given how big of a lift it is. But we'll see it with folks with core businesses that start to struggle, and they kind of look at this as a next growth leg.
Sheel, what about you?
Yeah, if you look what's happening in emerging markets, first look at China. I don't think China necessarily can be replicated here, but the big internet companies are all in payments, all in banking. If you look what's happening in India, so the government has an open payments initiative that lets people pay peer-to-peer. And so the biggest player was Paytm, and then the government opened it up, and Amazon, Facebook, and Google all have massive success with payments apps in India. And I know they're doing the same. Some of them are going after Africa with a similar thing. I think they're going to go after this lower hanging fruit where there isn't an established place that everyone goes to, like banking services aren't as popular there. So they'll go to these other markets first, and then I could see them coming here as well, though. There's a natural reason for it, especially Amazon. There's a lot of money to be saved, frankly, given the amount of commerce they do.
There's a correlation to how those particular markets are regulated as well.
Yep.
Let's talk a little bit about Insure Tech. You've seen that's one of the spaces where you've seen a bunch of IPOs between Root and Lemonade. and now sort of, Metromile getting bought by a SPAC, which we could go on for ages about SPACs. I think that was kind of unexpected for a lot of people. Great company. And the other ones coming up from the rear, Clear Cover, and Next Insurance, who just bought a company today. We did a report a few years ago, Insure Tech riding the wave. This space was one of the sleepiest out there, and all of a sudden took fire. Dan, what's your view of that space right now?
I think you just directed that at me. Yeah, look, I think we're excited about the promise in Insure Tech. We're investing in it actively. I think I underestimated how freely available capital would be, which has really enabled players like Root and Lemonade and others to grow to very substantial scale. And the name of the game here is growth and scale. I think the question over time is, when we return to an environment where you can get yield in other places, how will these companies be valued? Today, they're valued very richly relative to their more traditional incumbent peers. And so I think there's a question there.
That may be the understatement of the panel.
What's that?
Yeah, that may be the understatement of the panel. But yeah, evaluations are nuts. But if you're going to build the next Progressive or Geico in the digital age, which doesn't exist today, those are pretty big companies, right?
Well, and let's be honest. Those companies have moved way too slowly on innovation, especially around interfaces, especially around user experience, and especially around taking people and old processes and making them more efficient. And now they're facing a lot of disruption.
And you're absolutely right, Steve, that there's a ton of activity in this space, and that the big guys and the incumbents are sort of talking a good game about full innovation and change. But part of the reason is because they've had to, right? This has been an area that was ripe for innovation for so long. The good news is they haven't had a lot of legacy systems and legacy problems they have to undo, because they haven't really done a ton in the last century. And so I think part of the activity we're seeing is in large part because there's so much that can be done new, and you don't have to worry about add-ons or a piece of this that you have to buy, and it can go into the market and build new companies and new ideas. But I do think that the big opportunity that we continue to see in insurance is yes, these B2C things are going to be fantastic. They're continue to grow bigger than a lot of the insurance, but there's a ton of really amazing sort of business to business kind of within the insurance space that is low-hanging fruit, and particularly in the early stage. Those are going to be the really great, and it's why we're so active in the early stage space.
Why is it in Europe? I mean, open question. Why is it in Europe there hasn't been as many big names as what we've seen here in the US? Does anyone have a view on that? I mean, the names here are huge when they trade it. I think a Lemonade is $3.5 billion business on $100 million of revenue. So it's very impressive. I think, but that scale, 100 million in revenue is nothing to laugh at. So why is it not bigger?
Unfortunately, I'm short Lemonade, and I know that Lemonade's actually almost a $6 billion business.
But why is that though? Why is it Europe hasn't had a?
I think part of it is that they were kind of second to the starting blocks, right? And I think the U.S. market kicked off a little faster. I think they're coming. All of our work really is in the early stage, pre-seed, seed A, and now we've got venture growth activity. But the stuff that's sitting kind of sweetly in that venture growth pipeline is looking really robust out of Europe. So I think it's just a matter of time.
Yeah, open question, and maybe I'll direct this at Michael. I'd say for the last 6 years, the mantra has been, look, there's an enormous amount of private capital available. All the public guys were coming in the private market, and nobody really wanted to be public. And I'd say it's got to be within the last year or less. The SPAC market and the IPO market, particularly for fintech, but all sectors have just gone, wild. And it's sort of the place to be. You're seeing companies that would have never gone public 3 years ago go public right now. What's been the switch? What's the catalyst to that, Michael, in your opinion?
You're saying just from staying private to SPAC and IPO?
No, just I think the mantra a year and a half ago was stay private as long as we can. And now it's more and more companies just getting public. The public market's hot now. We're hearing that every day.
I mean, look, there's a premium to having your shares freely traded, right? And I think to the extent you can get out and the same amount of capital and valuation is there, why not do it? And I think historically, maybe there's a little bit of arbitrage in staying private longer. You can get a valuation that maybe you couldn't get in the moment in the public markets, but public markets are rewarding that today. So I think that's probably the key difference in my mind.
Yeah, and I don't think you can underestimate, Steve, as you sort of mentioned early on, that this is now on trend, right? That everybody and their brother is a fintech investor, and everybody and their brother thinks they understand fintech. So that gives a lot more consumer power to the idea that somebody might understand your company well enough to want to invest in it. And I think a lot of our fintech companies, that particularly those that aren't really consumer players, have struggled with sort of trying to attract that kind of consumer mindset when you think about who you want to attract when you're going public.
I'd also don't underestimate too the cycles in the broader venture market, right? Right. So the average venture fund is a 10-year life vehicle, and we're coming up on that decade mark of this bull run. So as you see, kind of there's a demand to get liquidity, I think, amongst venture investors. And by the way, there's a ton of capital in the world seeking high growth assets. So it's it's a match made in heaven right now, and I think that's why we've seen such a good year.
Exactly. Anyone want to comment on the SPAC market? SPAC versus IPO. It comes up every day. Anybody have an opinion?
Someone got a SPAC here? Someone must have a SPAC on this phone. Steve, you've got one.
I don't have a
SPAC. We should send it back to you.
I don't have a SPAC. I might. You never know. You're going to back it.
Feels like different things, right? I mean, different horses for different courses, or I don't know. I don't know what other people's views are on it, but
yeah, I mean, we're bullish, and I think in large part, kind of what I said earlier, it's a lot of these companies are hard to understand, and they're hard for the public consumption market to understand. And SPACs are quite beautiful in that matter, that you can SPAC a company that nobody cares about and nobody knows what it is, and then all of a sudden you pull the hood up and you're like, whoa, what do you mean 200 million in revenue? What do you mean this company should be valued at $2 billion? I don't even, I've never heard of this place. And a lot of the companies in our sector are places that nobody's ever heard of.
Gotcha. Last question for everybody. Obviously all the well-funded, bigger companies, they've got advisors, they've got tons of capital, they're doing great. But what's your advice to entrepreneurs and that are getting going, or just building up their businesses that are early on? You guys have seen so many companies. What's the 2-minute or 1-minute advice per person? Amy, we'll start with you. Yeah, I mean, ours are, we get the luxury of working with founders that are probably, one founder, 2 founders, 4 employees at most when we're looking at these companies. And what we always say to them is to just there's so much money out there. Just be really conscious who you're taking your first check through. And these are not, don't be so sensitive to what the terms are at your seed or your A. Be conscious of who you're getting your money for and where are they going to be at your, when your A is going to your B or your B is going to your C, because that longer term relationship and the ability to support your companies and their growth, not just with capital, but with other services. And all of us are really familiar with the sort of platform model. And we do this kind of, in our sleep now, that the most important thing for an early stage startup is not necessarily, the difference between a $5 million or a $15 million valuation in your seed round. It's knowing that I have somebody I can call to help me recruit if I need somebody, or somebody to bring in to get into a certain bank or some insurance company that would take me otherwise a year to do. So it's not just about the money and it's not just about the valuation. It's just about making sure you've got a longer term partner. Sheel, what's your 20 seconds of advice, Sheel?
Yeah, sure. I can't disagree with Amy. I think what we say is, work with us. We're former founders, and that's important. Like we have founder empathy. All we do is fintech, like everyone on this panel, like most of us on the panel. And so we've done this shit before. We can help. Go find people that you want to work with, that you want to spend 10 years with, who are going to help you every step of the way. That's all. Michael, what's your 19-second advice for founders?
I'll be shorter than that. Amy and Sheel nailed it. I think people matter a lot, and just pick somebody you want to spend the next 10 years with. It really does matter a lot.
Gotcha. Dan?
All of that, plus pick something hard. Pick something that a bunch of other people aren't trying to do, and go where all the smart people aren't.
There you go. And Andy, wrap it up for us here, buddy.
Yeah, look, I mean, I would agree on the individuals involved. And every transaction we're part of this year has been a massive, and our later stage has been a massive exercise in referencing and all the little incremental ways that you treat people and the investments you make and the humanity you show kind of builds up. So I think, a strong referencing campaign is super advised, and it's happening a lot right now, given you can't meet up and have that kind of face-to-face interaction.
So it sounds like the advice is all about the people. It's about the team. It's about what you do. It's about your passion. And it's about working with great VCs like all of you guys. So listen, thank you guys for everything. And I hope everyone's families, friends, and businesses are all safe and good during this crazy coronavirus world we're living in here. So be safe, be well, everybody. And thanks to all the panelists and for Singapore FinTech Festival helping us out here doing this. Thanks, everybody.
Thank you, Steve, and thanks to your panel of investors for sharing their insights to investments for the coming year.